Hello students, and welcome to the first video for Chapter 2 of Principles of Financial Accounting. Today we're going to talk about a topic that is difficult for a lot of students, and that's the debit and credit rules. If you learn this chapter and the debit and credit rules successfully, then you probably won't have any more difficulty with the rest of the semester. However, if you don't learn the debit and credit rules and you try to continue on in the textbook, you probably will have difficulty with the rest of the semester. Okay. Alright, the first thing I've done is put the accounting equation in its extended format at the very top. That's assets equal liabilities plus capital plus revenue minus expenses minus drawing or the withdrawal account. And underneath it, I'm going to show you how each of these types of accounts are increased and decreased. What I have here and under each of the types of accounts is what we call a T account. And it's called that simply because it looks like a T. But what it is a form of ledger. And a ledger is where we accumulate information in a particular account, such as cash. We show the increases and decreases and the balance in that account. The T account is not the type of ledger that we typically use in accounting, but we use it for analysis purposes and also to learn debit and credit rules. Now you will notice that the T account has two sides. It has a left side and a right side. And you'll also notice that every T account that I put up here, on the left side I have put debit, and on the right side I have put credit, because the debit always goes on the left and the credit always goes on the right. That will not change. So when you're dealing with T accounts, the debit will always be on the left, the credit will always be on the right. Okay? Now what we're going to talk about is how we change these accounts. And the first one I'm going to talk about will probably be the most difficult for you because of what you already know in your own life about debits and credits. And that's assets. Let's look at assets. Assets would include cash, accounts receivable, equipment, buildings, those types of things of value. We talked about that in Chapter 1. All assets, including cash, are increased with a debit and decreased with a credit. Okay? And I've also shown that up here. Assets are increased with a plus sign with a debit and decreased with a minus sign with a credit. Okay, now that is true. That's a fact. Trust me. Later on I will explain to you why you feel like that may be a little opposite of what you know in real life. There is a reason. But first let's learn the debit and credit rules. Now, since this is an algebraic equation, you would expect everything on the other side to be just the opposite. And it really is, but we do have to explain a couple of things over there. Let's look on this side, and you see liabilities and capital, and of course assets equal liabilities plus capital, owned as equity, is your main accounting equation. And your liabilities and capital are both increased with credits and decreased with debits, which is what we would expect. And then we get to the parts of capital. Revenue we talked about increases capital, expenses decreases capital, drawing decreases capital. So since revenue increases capital, it's going to have the same types of entries that capital does. So it's going to be increased with a credit and decreased with a debit. However, this gets a little tricky. Since expenses and drawing decrease capital, the entries going through these accounts are exactly the opposite. In other words, to increase expenses or to add to the expense account, you would debit it. To take away from the expense account, you would credit it. To add to the drawing account, you would debit it. To take away from the drawing account, you would credit it. So these three are increased with credits and decreased with debits. That's liabilities, capital, and revenue. And these three are, these two rather, are increased with debits and decreased with credits. Okay, now I told you that I would explain to you why it seems that the cash or the assets is opposite of what you think about in your real life. And there's a very good reason for that. You think of your cash and your checking account or your savings account as being an asset to you, and it is. But guess what? Your accounts are not assets on the bank's books. Okay? Actually, if you take a deposit in, you're going to take in cash, they're going to add that to their cash with a debit. And they're going to take the deposit slip that you give them that has the information about your account and add it to your account, and that's the credit. So you give the bank teller a debit and credit when you hand them a deposit slip with cash. The entry to the bank on the bank's books is a debit to cash and a credit over here to a liability account called maybe demand deposits payable. The point is, the bank has a liability to pay that money back to you. So therefore, it is a liability on their books. You have to look at the big picture. You have to look at the bank's books and the way the bank looks at it in order to understand why the bank credits your account when they increase it. And the simple reason for that is because your account on the bank's books is a liability. It's not different. It's not backwards. It is simply just the way that they record your account on their books. And students, it's just as simple as that. Don't make the debit and credit rules difficult, because they're not. If you have any questions, please don't hesitate to contact me. I'll be more than happy to help you. In the second video, I'm going to give you a memory jogger which might help you to learn the debit and credit rules. But that's all for now.